good morning and welcome to today's episode of Modesty's Monday Motivation. This is episode 10. So we've made it to the 10th week of this series since we started. And this is a special one for me because of the number 10. And it coincides with my wedding anniversary. So I've been married for 10 years, and in this December I'll be celebrating my 10th year wedding anniversary with my lovely wife. So episode 10 is a special one for me because of the number, and I'm looking forward to many more years of marital bliss with my lovely wife. So you better listen very carefully in this episode because there's a little bit of excitement and a little bit of emotional attachment to it. So, and this is the first episode after I have taken the feedback into consideration about the length of our presentation and our talks on topics every Monday. So the feedback we've been getting is that it looks like the episodes and the previous episodes we've been doing are a little bit too long, and some people are complaining because of where they are. They cannot afford to have data to, internet data to be able to watch everything for that long. You know, those of us here in the UK, we are lucky enough to be able to access internet data cheaply. These days, phone companies throw unlimited data at you, at will. So we've taken that into consideration, and from this particular episode upwards, we're going to be delivering, shorter episodes of this presentation every Monday. The most important thing for me is for you to consume the content, understand what we want you to understand, and get the message, run with it, and apply it in your personal financial lives. So I'll try my utmost best to make this as short as possible. I'll try my utmost best to, jam-pack a lot of things into the short time I've mapped out for episodes for this from this day onwards. So please permit me to do that because I'm a detailed person. I like really going into things in details, and because I would like things broken down to me very well, and I like understanding everything very well before I do them. So that has been what's been basically helping me to drive this series forward. I've also had some fantastic feedbacks as well as per how simple we've been able to break down even complex financial topics to the layman's language, and people are understanding even things that they did not understand before. And we appreciate your comments, we appreciate your compliments, we appreciate your support, and we say keep them rolling in. The negative and the positive ones, we welcome them and we work on them because we listen to you, our audience. Without you, there is no point being here. So it's a cold morning here in the UK, and as you can see, it's reflected in the way I'm dressed here. I'm really I've really got myself padded up, making sure that I keep as warm as possible so that I will at least be strong and healthy enough to deliver what I need to deliver to you this morning. So I hope you pardon my outfits. I'm only trying to stay alive. It's only when I'm alive that I'll be able to do this for you. So this morning we'll be talking, we are still continuing on our investment component series. Remember, for the last 2 weeks, we've been talking about things that make up investments. We've talked about inflation 2 weeks ago. We've talked about borrowing last week. So we have today we are going to be talking about something that is very essential which is called risk. So today we'll be talking about understanding risk as a component of investments. And just to prepare your mind towards something like that, a lot of us have been hearing about the word risk, and a lot of us know what risk is. Some may have a shallow understanding of what it is, but we want to bring the word risk into investment and in the financial world, what risk represents and how we should approach it. Okay, so a bit of background of what's my last week has been like. Excuse me. I've got something to really be grateful for, because I'm talking about risk. This really relates to what I'm going to be talking. Just to tell that we live in a world where risk is always around us. There's always, risk of things going wrong, and risk of things being lost. Really. On Friday, my wife gave me a call, and she was telling me about what happened in the house where I wasn't there, and it happened to be that my little boy, the last of the three, he was given some ground nuts to chew with his older siblings, and what he did, instead of taking the ground nut and putting the ground nut in his mouth, you will not believe it, he stuck 2 grains of ground nut in his nostrils, and nobody knew that he did that until he started feeling uncomfortable, and he came to sit beside my wife, and he was crying and he was pointing towards his nose, and my wife was like, "What's going on?" What? He said, "Groundnut." My wife said, "Groundnut, what happened to your groundnuts?" He said, "In my nose." He said, "Did you stick groundnuts up your nostrils?" And he said, "Yes." My wife screamed. She just practically brought her food to eat. She just dumped the food, and the struggle and the fight was to get those 2 grains of groundnuts out of his nose. And then she said to him, "Okay, Williams," now because he was really crying then, and he was really feeling, and he was really scared for himself as well. And my wife said, "Okay, calm down. Can you just basically like sneeze or blow your nose so that you can blow those things out?" And then rather than blowing the groundnut out, he was sniffing. So the grains of groundnuts were practically going even deeper into his nostrils, and his brother and his sister just started crying. They were so scared. My wife was confused. She said, "What am I gonna do? How am I gonna get this out of?" So the more you said blow, he was sniffing. My wife said, "Okay." My wife stopped asking him to even blow or to sneeze. She was just practically trying to even pat him on the back and say, "Can you just," he said to my eldest daughter, "Can you get me something with a sharp end so that I can see if I can get this thing?" She was so confused, and as she was telling me this story, like goosebumps was all over me, while I was like, how did he happen to get those? Why did he have to stick those things up his nostrils? And he's just adventurous, but he was too adventurous for everybody's liking. So to cut the long story short, somehow he was crying, he was not steady, he was jumping up and down, and somehow the 2 grains of groundnut, he jumped and he basically sneezed, and the 2 grains of groundnuts fell off his nose. And that was how close, he was to something catastrophic happening. We don't know what would have happened if he continued sniffing and sniffing, and those 2 grains of groundnuts ran. It could end up in his brain, it could end up anywhere at all that it cannot be reached, and it could cause some serious and severe damages to his health. He could even die. So that is risk. So we live with risk every single day of our lives. Some of them we can control, some we cannot control. Some of them we are prepared for, some we are not prepared for. And then another story that resonates with me with risk is I was at a friend's place this weekend, and he was sharing a story of the shortest employment he has ever had in his life. And he said he was working for this particular organization, and everybody in that organization, the staff basically, they were all complaining And they kept complaining. Every time they come into the staff quarters, they keep complaining about the organization, about the job. They keep moaning, basically. So there was so much negative energy in the room. And because it went against his values, he couldn't live with that. And he kept asking those people who were moaning and complaining at work, so why are you still here? And some of them have worked there for over 10 years. Some of them have worked there for donkey years, but they're still there moaning every single day at work. Because it did not coincide with it did not correlate with his values, he had to quit. He spent only 3 months in that place, and he quit the job. Now, the risky part of it is that his papers were dependent on him being in that job. So by quitting that job, that employer was a sponsor, and the employer pulled the sponsorship, and the Home Office wrote him a letter and said he had 28 days to leave the country because he had no sponsor, so he had no papers. He can no, unless he finds a job, another job within that 28 days. So to cut the long story short again, his wife found something on the line and said, can you apply for this job? I think this job is perfect for you. Initially, he was reluctant, but he decided to follow the wife's advice. And he applied, and the job was right for him, and he got the job. And then he was able to, get his papers back because those guys became his new sponsors. Now, that also was risky. Risking his stay in the country because things around him didn't fit into his values. It's risk. But he had to take that risk because he felt it was worth it, rather than, having it damage him personally, emotionally, and psychologically, and working in an environment where there's so much negative energy and people are always wondering. He would rather not be with a job than stay in that job and continue to, listen to those things every single day. So that brings us into today's topic of risks and understanding risk. Now, I've been making a research aspect just to give you a general understanding of risk. The risk is the potential for uncontrolled loss of something of value. Risk is the potential for uncontrolled loss of something of value. So the key word here is potential, and another key word there is uncontrolled, and another key word there is loss. So there is a risk of loss of something of value, and the risk is a potential. Risk is not definite. There is no guarantee that that risk is going to occur, but there's a potential that risk is going to occur. So it is a measure of the potential of that thing happening. That's basically the risk that you are taking. That there is a possibility that this might happen, which will go against the expectation of whoever is engaging in that activity. And that's where risk, is best described. So there is a potential for the loss of something, uncontrolled loss of something of value. The other keyword there is value. That thing must be of value to you as well. So the value could be health, it could be wealth, it could be life, it could be investment, it could be money, it could be anything that is valuable to you. So that is why people insure against risk, because they value that thing. If they value it, they try to protect it, against the risk of losing it. So, and that's risk. Those values can be, those valuable stuff or that thing that is valuable to you can be lost as a result of you taking risk through your actions or inactions. And those risks that you have taken might be planned, they might be unplanned. They might be foreseen, they might be unforeseen. So basically, your action or inaction could potentially result into a risky venture. Some people think that by not doing anything, they're not taking any risk. Inaction on its own is a kind of action, and it also has risk associated with it. Sometimes when you do nothing, you risk everything. And sometimes when you do something, you engage in a higher risk. Now also, while I was researching, there was another definition of risk that I came across on Wikipedia, where it says that risk is the intentional interaction with uncertainty. That risk is intentional interaction with uncertainty. So intentional means that you know exactly what you're doing, you know exactly what you're getting yourself into. Uncertainty on one hand, you on the other hand, and your intention is to take a decision or take an action. In spite of the uncertainty, you know that there is no guarantee on this particular thing, but I'm going to take a chance. So really, risk is about you taking a chance on anything. So it's an intentional interaction with uncertainty. And uncertainty is a potential, unpredictable, and uncontrollable outcome of an activity. So, the outcome is uncontrollable, is unpredictable. So there's uncertainty there, but risk is an aspect of an action that you have taken in spite of uncertainty. So that's another dimension which you can see risk. But I want to talk you through 4 different types of risks that just to give you a general idea of the type of risks that you need to know about. It doesn't mean that those are the only 4 types of risks that that exists in this world and on this planet. There are several other types of risks that you can also encounter. But I just want to limit it to 4 because it's going to it's interwoven kind of, and it links into what we are doing in your financial life, your investment life, in taking financial decisions, certain types of risks that I want you to be aware of. The first of them is mortality risk. Mortality risk. So mortality risk simply is it's a question of whether you are going to die before your money or your money is going to die before you. Mortality is a question of whether you're going to die before your money or your money is going to die before you. So simply put, it is, do I have enough money to last me for how long I'm going to live? Or is my money going to run out while I'm still alive? Okay, so that's mortality risk. So the challenge there is therefore to find a balance between getting enough money to last you a lifetime and not running out of money. Because the risk also is that you can plan for your lifetime with the money to last you for a lifetime, and if you take it too far forward, you might end up spending your money in little bits and chunks, and then you might die and you leave a lot of money behind without actually living a fulfilled life. Or you might have such a short kind of plan or view of how much money you need to live on that you may not have enough money to last you for a long time. So basically your money can actually run out before you die. So for some part of your life, you're going to be living without money. So those are the 2 extremes. The challenge, therefore, is to find a balance in between, to find out how can I manage my finances and how can I plan my finances in such a way that I will live, and for as long as I live, I will have enough money to enable me to enjoy life. Do you know that when you interact with people and you ask them, when do you think you are going to die? People basically get shocked when these questions come to them as blunt as it is. But the truth of the matter is that death is a reality. And if you don't talk about it, you're not doing yourself the best of favors. So when you ask someone, when do you think you're going to die? It basically means, what is your life expectancy like? So if you call it life expectancy, people feel more comfortable. But when you say when do you think you're going to die? Somebody might even accuse you of wishing him or her death. But that's not the right. So in the financial world, it's a reality that we have to deal with every single time. And people have to come to realization that you're not going to live forever here on earth. So if I ask you as a client, how long do you think you're going to live? When do you think you're going to die? It's not that I'm trying to, put it in your face. It is simply that I'm trying to bring the reality to you, so that whatever you've been avoiding, you know that it's a reality that you're going to face up to. So, but there are certain parameters that developed economies and nations use to measure life expectancy. And people plan their lives along the lines of those life expectancy predictions. So life expectancy is an important aspect of financial planning. If you do not know what life expectancy is around where you live or the part of the world where you live, try and find out and research. It simply means how long do people in this area live for? And then take an average of that. You can structure your financial planning along that line. Because what happens is that when you avoid those questions, later on in life, those questions you've avoided will come haunting you. Okay? So that's mortality risk. It's basically risk of death. How long are you going to live? When are you going to die? Would you have enough money to live on if you live longer? Now, the other type of risk, number 2, is morbidity risk. Morbidity risk basically is about what will happen to your finances in the event of ill health or accidents or disability. What will happen to you? What will happen to your loved ones? What will happen to your finances in the event of ill health, in the event of disability, in the event of accidents? Some people in this part of the world have mortgages. And whether or not you are well, there are certain things you've got to take care of. Your bills, your daily life, the mortgages, the rents have to be paid. The electricity and gas bills have to be paid. Water bills have to be paid. Your council tax has to be paid. All the bills you have, they've all got to be paid. And these companies do not give a damn what your health situation looks like. If you call them on the phone and say, oh, I was involved in an accident and I broke 2 legs and I can't go to work, blah, 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 they will empathize and sympathize with you over the phone, but at the end of the day, the bills will still keep coming to your doorpost. They will not stop sending the bills your way. So morbidity risk is about health and wellness, planning around that and realizing that that is a risk. That's potentially something that could happen. You could go out there and get knocked down by a car. Some people think that because they are people of faith, these things can't happen to them. It can happen to anybody. Do not let anybody deceive you, and do not let your faith tell you that you are living above risk. Nobody is living above risk. It can happen to anybody. If you drink and drive, the risk of you getting an accident is even higher. So sometimes your activities can increase the level of risk. It's not that the risk is absent, but some of the actions you take actually minimize those risks. But the risks are still there. If you don't, run into anything, something can run into you. You might be so careful, but then a drunk driver can just come knock you off your perch, and then there you go. You might end up in a wheelchair. You might end up in the hospital. You might end up bedridden for the rest of your life. And when that happens, what is going to become of your dependents? What is going to become of your finances? Your income is your biggest asset. And morbidity risk really affects your income. Really is affected by your morbidity risk, because then if you're not well enough, if you're not strong enough, you're disabled, you can no longer earn an income, unless there is something else you built around yourself that can generate you that income. It is not to say that people who are disabled don't earn income. They do earn income, but it is the chances of that income coming in that state is very, very low. So morbidity risk is another risk you have to be aware of as a person. Now there is a relationship between mortality and morbidity risks. Some mortalities that people, some deaths, you can see traces of them, say, in a family line, or some illnesses are linked to family lineage. So it's very important that you also find out what sort of health issues that that is in your family lineage. There are some people whose parents have suffered certain types of illnesses, maybe diabetes, cancer, stroke, heart attack. Find out if there is any sort of sickness or illness in your lineage that you have to be prepared for, that you have to, guard yourself against, and see how you can mitigate against those risks. Those risks are real. And that's why when you go to take life insurance, the insurance company asks you questions about family. Has any member of your family suffered from this kind of illness or that kind of illness? And you've got to answer those questions because it helps them measure the level of risk exposure that they are covering here. And if you don't give them full disclosure of those things and they happen to find out later on, maybe when the risk occurs and you want to make a claim, it could affect your claims. And then people go about shouting, oh, insurance companies are criminals. They do not pay out when... But you do not know the full story. Yes, there are some rogue insurance companies out there, but there are also some rogue insurance clients out there who are just trying to take advantage of situations when they have not given full disclosure beforehand. So you've got to also be aware of that. So when you are planning your financial future, take into consideration your family lineage and see if there is anything there that you need to plan or you need to inculcate into those plans. If there is any sort of illness in there in the family lineage that you need to, build into that while you're planning it, because it could affect your life expectancy. And that is the truth of the matter. It could be that sickness in your family lineage is something that is transferred from one generation to the other. If you know about your family health history, science and technology these days are providing measures that people can live longer when they apply them. But you have to be aware of it first of all before you can take advantage of the solutions that exist. So being aware of that is a plus for you because at least you know that risk exists and then it can help you to plan towards mitigating it. Now, the third type of risk I want to talk about and I want you to be aware of is inflation risk. If this word inflation keeps coming up every week in our discussion, and that is to tell you how important it is. A couple of weeks ago, I spent time on one of our series talking about inflation. So if you go to my Facebook page and check out my videos, you will see the session the episode dedicated to inflation. So go and check it out and read up, listen to it, and you can understand a lot more about inflation, where we have dedicated a full episode to get. Inflation risk is basically a question around what is going to happen to the value of my money over time. The money I'm putting away, the money I'm saving, the money I'm investing, the money I have in the bank, what's going to happen to them? Inflation only affects money. Anything that has financial value is affected by inflation. So inflation risk is a reality because on a longer term, especially if you have a long-term investment, it's very important that you are aware of inflation risk and you build it into your investment and financial planning, because it's simply a question of what's going to happen to my money over this period of time. How is the value of my investment going to be affected by inflation? Is it going to, obviously, your purchasing power is going to be reduced by inflation over time, meaning that what £100 can buy you today, it cannot buy you the same thing in the next couple of years. Say in 5 years' time, the purchasing power of £100 would have reduced by a certain percentage. It could be by 5%, it could be by 3%, it could be by 4%. So it's very important that you are aware of inflation risk and how it affects your financial plan and your finances. And inflation can actually work for or against you. Inflation can work for or against you. In the episode where we spoke about inflation, we talked about inflation working in favor of those who have good debts. So debts, there are good ones and there are bad ones. Bad debts, we said, there are debts that you have incurred and you have squandered them on things that does not appreciate in value. For example, you took out a loan to go on a holiday, you took out a credit card to, do some shopping. It's Christmas, and the application for credit cards is always at its highest during Christmas. And spending on credit cards are always at its highest during Christmas. And then when January comes and the bill starts coming in, the reality starts setting in, and people now know how much debt they've got themselves into. Emotionally, Christmas, everybody just wants to spend because it's the time for spending, and the ads and the jingles are going out there, and all sorts of sale and promos are going on there. The temptation to spend is there. People rack up personal debts during that period. Those are bad debts because they are like debts, money you spent on buying a car. Those are things you are spending, money you have borrowed money on that do not appreciate in value. So inflation does not work in your favor in that instance. But when you borrow money to invest, say in something like property, over time, as inflation erodes the value of money, it also erodes the value of the debts. So if you take out a mortgage and invest it in a property, for example, and you've got a mortgage of £70,000, today you borrowed 70,000 from the bank and you bought that property. In 25 years' time, that 70,000 is still there as a capital repayable to the bank or to the financial institution. But the value of that 70,000 is no longer the same in 25 years' time. So inflation has helped you in that instance to erode the value of that debt, such that when you are repaying that debt, what you are paying to the bank is not the same value as what you borrowed from them years ago. And over that period of time, you have leveraged on that money to make money for yourself. So you have earned some profits on that. And that asset must have appreciated over time, over that period of 25 years' time. That property that was worth 100,000 then could have been worth like 300,000. So if you sell it for 300,000, then which is the real value of the property as at that time? Because property inflation has worked in your favor as well. So in property, for example, inflation is a good word in property investment, because property inflation means that the value of the properties are appreciating, the value of the landed property. So the same goes for some other assets like gold, silver, and equities, shares, stocks. These are over a longer term. Over a longer term, these assets do appreciate, and inflation is what helps them to appreciate in value. When you hear the appreciation of assets, it simply means asset inflation. It means those assets are growing up in value every time. And that's the same thing that inflation does. The higher the level of inflation, the lower the purchasing power of whatever money or currency you have in the bank. So if you leave your money in the bank, the inflation is working against you. It means you are deliberately losing money. So inflation risk is a reality when it comes to investment decisions and when it comes to financial planning. So it is a risk of the value of what is going to happen to the value of my money with regards to inflation. So if inflation is increasing by 2.7%, for example, every year, and the value of your investment or the return on your investment is not increasing at the same rates or surpassing it, it means that investment is losing money. But if inflation is increasing and the value of investment is increasing below the value of inflation, you are losing money. So those are the risks you have to bear in and you have to be aware of when you're talking about inflation risk. Now, the fourth risk I want us to be aware of as well is investment risk, which is basically the one I'm going to focus more on, not basically in this episode, but in the next episode next. But I just want to introduce that to you, and let's have an introductory side of it, because I have promised that I'm going to be making the episodes shorter than they used to be before, so that we can have enough time to digest them, and those who want to come back to watch them will not have to spend so much time, and their data bundle watching that. So we are considering everybody from everywhere, and we're taking those feedbacks on board. So investment risk is basically what is going to happen to the money I invested. Will it go down? Will it go up? You know, there are simple investment terms goes like this. The higher the risk, the higher the returns. So investment risk is measured against the expected return on that investment. So wherever you hear investment, you're hearing about risk and you're hearing about return. So when you measure the risk against the return level, it tells you whether where that investment sits. So the simple term that we are used to in investments is that the higher the risk, the higher the return on that. So some people are risk averse, some are risk takers. Some people take more risk than the others, and that's why investments rewards those who want to. The returns are bigger for those who are happy to take a bigger risk. And those who want to play it safe, they get a lower return, but at least they get some level of safety, because that is what their priority is. So in investments, you've got to decide what your priority is. Is your priority to maximize the return on that investment? You have to be prepared to take a lot more risk if you want to maximize that return. Or is your priority just to play it safe and get this money safely put away, invested somewhere? No matter what it yields, I'm fine with that, but safety is what matters more to me. So risk and return are things that go hand in hand, and the both of them are always going at the same level with each other. The lower the risk, the lower the return. The higher the risk, the higher the return. But then there are other investment risks that I just want to touch on at this point. First of all, you have to consider in investments the risk of fluctuation. The risk of fluctuation basically is just to tell that your investment can go up, it can go down. So when you are going into investment, bear it in mind that that investment has a potential of going up or going down, as long as it doesn't come with a guarantee. And there is really very little that comes with guarantees these days as far as investments are concerned. But there are investments that do come with guarantees. They give you a guaranteed return. But that guaranteed return doesn't necessarily mean that it's complete absence of risk. It simply says that in terms of returns, you have a guarantee on this, that this investment is going to return this to you. So the risk of fluctuation is a reality in the world of investments. So if you go into like shares, for example, you invest in stocks and shares, the prices of those shares can fluctuate. It can go up, it can go down. And the fluctuation also, say you want to invest in properties, interest rates can also affect the returns you're going to get. Government policies can come up and it can shoot up interest rate. It then means that your profit is hit by the interest rate, meaning that you're paying out more interest to the bank. So fluctuation is a reality and is in the world of investments. The other type of risk associated with investments is risk of loss, total loss in this case. You can potentially lose every single thing that you've put into that investment. It's a reality. So when you're going into an investment, bear it in mind that everything you're putting into this investment, you could lose it. Is a possibility. And if you're not prepared to lose everything that you're putting in there, do not put it in there. So invest as much as you are prepared to lose. So ask yourself, if I'm putting this much money into this investment, am I prepared to lose everything there? If you're not prepared to lose everything, then don't put it all there, because it's a possibility. No matter the type of investment, it could be property, it could be stocks and shares, it could be bonds. The company can just go bust, and as a shareholder, you've lost everything. I gave an example of Debenhams the last time I was speaking. Debenhams went into administration. All the shareholders of Debenhams, Mike Ashley, the owner of Newcastle United and Sports Direct, is one of the major shareholders of Debenhams. He lost everything. we're talking about hundreds of millions of pounds in his own case. He even made the administrators an offer of over 200 million pounds to save the company. The administrators said the offer was not good enough, they wanted more. And he said, well, that I cannot give more than I'm giving you now. And they said, well, we're calling in the administrators then. The creditors rejected his offer, they called in the administrators, and they took control of the company, and all the shareholders lost everything. So, but then there are other investors, stakeholders in Debenhams who are not ordinary shareholders. Maybe they are bondholders, and those people, when the assets of that company is liquidated, they will be paid first because their sort of investments are bonds, which is not affected by, they don't completely lose out. But if the assets are realized, they are part of this first set of people who are going to be, paid because their investments are secured against the assets of the company. So if your investment is secured against the assets of the company, you have limited interest in the company. Your interest is limited to as much as you have lent to the company, as much as they have borrowed from you. Now, the number 3 risk that we're going to look at, the investment risk, is a risk of access. Sometimes, especially for long-term investments, if you put money into a long-term investment that is only realizable, say in 10, 15 years' time, you've got to be aware that that money is locked in. It's not going to be available for you for that length of time that you have put it in. So be sure that you are prepared to lose that access to that money for that length of time. Because if you decide to cut that investment short, you are going to be penalized by the company. Because it's an agreement, it's a contract, it's something that you signed up to. Oh, I want to invest this money and I want to invest it for this number of years. So the company would have factored that into their investment program. They would have factored that investment into their growth strategy as well, to say, we've got this much funds locked in for the next 5 years. These people don't need it. So for the next 5 years, we know these are the creditors that are due in 5 years' time. So the moment you come knocking and say, hey, something has happened, I would like to have access to my money, it's not that easy. You've got to be penalized if at all you're going to get that money, and you're going to get far less than what you have put in. So while you are drawing your short, medium, and long-term investment plans, be aware of the risk of no access to your funds for long-term investments. So if you need access to your funds in the short term, make sure you put them in short-term investments where you can have access to them. The other risk on investments is the risk of volatility. So volatility is basically the manner in which investments go up and down. Some investments are more volatile than the others. One moment, the price is up here, the next moment it's crashing. One moment the potential of returns. So there are some investments that when you see their returns graph, it's so zigzag. One moment it's up, the other moment it's down, the next moment is up. So some investments are much more volatile than the others. So when you're going into an investment terrain, find out what the volatility is like, and be sure that you are prepared for that level of volatility. If you are not prepared for that level of volatility, then do not go into that sort of investment, because it is not a safe one, for you. Okay, so I just want to stop here for the investment risks. Then I want to talk about how we can mitigate some of these risks that I have mentioned here. Because next week, I'm going to dedicate the whole of next week to investment risks. Then we can talk a lot more about some other investment risks that we've not been able to talk about here. Because this series, we are on an investment component series. So we want to really narrow everything down to how it affects investments. So but I decided to just give you a general picture of risk and some other type of risk you have to be aware of. Now that we know of these risks, how can we mitigate against these risks? First of all, let's see how we can mitigate against. Mitigation basically means how can we plan or against this risk, or how can we reduce the impact of these risks on us. In some cases, and in most cases, it's really very difficult to completely eliminate risk. So all you can do is just minimize the impact of that risk, or how you can mitigate against it. Now, mortality and morbidity risks that we talked about, how can we mitigate against that? First of all, and number one on that list is life insurance. Yeah, because we are aware that risk of life, of loss of life, is a reality. Risk of loss of income and loss of health is a reality. So let's talk about life insurance. Life insurance takes care of the mortality risk. It doesn't take away the risk of death, but at least it mitigates against the impact that it's going to have on your loved ones. You are not taking out the life insurance to protect your own life. You are using it, you are taking out that life insurance to mitigate the effect and the impact of the loss of your life on the people that you love and the people that you're going to leave behind. Because eventually we do not know when it's going to occur. But if it occurs, how is it going to affect those that are coming behind? If you love them that much, you've got to protect them. The protection is not basically for you, it's for the people that you love. So life insurance is one way that we can mitigate against a mortality risk. The other type of mitigation strategy is income protection. You see, some people just go about chasing income, and they don't realize that that income is their biggest asset. Because without income, you cannot even invest. Without income, your life stops. Basically, you cannot look after your family. So if that income, if everything around you borders around your income, how come you're not protecting that income? Because that income can stop abruptly. Sickness can stop it. Accidents can stop it. Critical illness can stop that income. What are you doing to make sure that the income keeps coming no matter what? That is what income protection does for you. So it basically covers the income that you are losing in the event of sickness or accidents. So if anything happens, the insurance company or the income protection firm will keep paying you the same amount of income that you're on, that you're protected, until you get back on your feet. And some income protection could even be for life. If you never manage to get back on your feet, it means for the rest of your life, they will keep paying you and keep making sure that the bills are paid. So if you have an income and it is not protected, you're exposing yourself to a bigger risk. So to mitigate against that risk, go out and seek an income protection. Talk to us or talk to a life insurance advisor and let them advise you properly on how much cover you need for your income. Otherwise, if anything happens to you, your income is gone and your family will suffer it and they will be hit most. Especially with a family where you are dependent on two incomes. Maybe there's husband and there's wife, and then one of them suffers accidents or disability. Your wife might end up looking after you, and you might end up looking after your wife as a result of that. It might mean giving up work to now focus on caring for your loved one. What is going to happen? The bills will still going to be paid. But if you've prepared yourself around these sort of risks, it makes life a lot easier. Number 3 is critical illness insurance. Critical illness. There are certain illnesses that are classified as critical illness. Things like cancer, like stroke, like diabetes, illnesses that are really serious, and they could actually mean you will stop working for the rest of your life. Now, this kind of critical illness insurance pays you out lump sum whenever this risk occurs. So it helps you mitigate against morbidity risk. Because if this insurance pays out while you are still alive, it's not when you're dead. It just simply means that you have suffered this critical illness. You might have a major operation, an artery bypass or something, and it means you can no longer do what you used to do. But if you had critical illness, and that critical illness was, say, it covered you for up to £200,000, the insurance company will pay you out £200,000 in lump sum, and it could make a huge difference for you. If you compare what you paid for that insurance, comparing it to how much value it's given to you in the event of that risk. Some people have taken advantage of that. It may be that your home may need to be remodeled because your life will completely change. and that money will come in handy to make life a little bit more comfortable for you. Number 4 is emergency fund building. We have talked about this when we did the episode on savings. We said the ideal emergency fund will be between 3 to 6 months of your current gross income. So whatever your current monthly income is, aim to build an emergency fund that is 3 to 6 months of it in a savings account, and you can dip hand into it, in the event of emergency. Number 5 is pension and retirement planning. So mortality and morbidity risks can be mitigated by appropriate pension and retirement planning, meaning that you are planning for when you are no longer able to work and for how long you are going to live, how much you need to live on at that time, and maintain either the same level of life, the same quality of life, the same standard of life or not. But this pension and retirement planning also could be affected by your, what your preferences are. Some people might think, by the time I retire, I just want to downsize, live in a 2-bedroom or 1-bedroom house. The them is that their major concern or their major plan will be, as long as I have enough to heat my home and stay warm even in the coldest of winter, that's enough for me, and then I get food to eat and all that. That's right. Some people, they want their retirement to be a time of adventure. Travel around the world, go cruising, do all sorts of things and see different places. That could, inform your choice and the amount you are setting aside in mitigating those, risks. So pension and retirement planning also is a strategy you can apply towards mitigating against those risks. Accessibility is basically you being aware of how accessible your funds is and how much you need to access to maintain your life, your quality of life and your standard of life. So if you know how much you need to live on, you will know where and how to place those investments and those funds to make them accessible to you. So if you know you are going to be needing this money in the next 3 to 5 years, do not go and put it in a 10-year investment, because in the next 3 to 5 years you will need that money. If you need it in 12 months time, put it in a savings account that matures in 12 months time, because then you will know that you will have access to those funds. So those are the mitigation strategies for morbidity and mortality risk. But then your inflation risk, how do you mitigate against inflation risk? The first thing you've got to do is to understand how inflation affects your finance. Again, I'm going to refer you to my Facebook page and watch the previous episodes where we discussed inflation in its fullness, and you will understand a lot better how inflation affects your finance, which we have also touched on here. Your understanding of inflation is the first step to you mitigating against inflation risk. If you do not understand it, it will work against you. If you understand it, it will work in your favor. Somebody said something about compounding interest. I read it on. He said, those who understand compounding interest earn from it. Those who don't understand it pay it. Yeah. So if you understand inflation, it will work for you. If you do not understand it, it will work against you. So the first step to mitigating against it is gain an understanding of how inflation affects your finance. Secondly, avoid keeping too much cash in the bank beyond your short-term need. Cash in the bank is not basically safe. If you put your money in the bank and you think, I've kept it in the bank, therefore all risks are averted, you're basically losing money. If the cash you keep in the bank is beyond what you need in the short term, you're losing money. You're cash rich, yes. It simply means that the cash in the bank is earning you nothing. Okay, so beyond your short-term need of cash, avoid keeping cash in the bank. Get that money working for you. Put that money to work. And that's the only way to beat inflation, because if inflation is increasing by 3 to 5% every year. It means the cash you have in the bank is losing value by 3 to 5% every year as it sits in the bank. It is better for that cash to be working and working hard enough to beat inflation than leaving the cash in the bank beyond your short-term needs, and you are losing money practically by keeping that money in the bank. So if you are the type that brags about how much you've got in the bank, you're actually bragging about how poor you can potentially be, because in the next year or two, the same money you have left in the bank untouched or whatever, it's gonna lose you money. That money will lose value, and you will not be able to purchase as much as you could have purchased with that money in the previous years. Number 3 is to build your inflation assumption into your investment planning. Your inflation assumption should be built in. Assume what inflation is going to look like. Look at the track records of inflation where you are. Read up on inflation levels in wherever you are based. And when you are doing your investment plan, if you're working with a professional, they will build the possibility of inflation into your investment plan and your retirement planning. There are certain retirement plans that when you take out your pension, your drawdown or your pension income will increase with the rate of inflation. But it will hit you more if you take out a level income drawdown or income pension retirement that does not increase with the level of inflation, and you haven't got other forms of assets and investments that increases with the rate of inflation to mitigate against that. You find yourself in a compromised position. Now, how do we mitigate against investment risks? First of all, you need to understand if you need to take risks at all. So most of the things I'm talking to you about here are things that I learned from, one of the people I really have very huge respect for, Pete Matthew. I listen to his podcasts every time, and his podcast is Meaningful Money. So a lot of the things I'm talking about here, most of the things I'm talking about here, I learned from Pete Matthews' podcast about risks, and they really, really made sense to me. And I felt I would share this with you, and let's talk about, let's educate ourselves on things like that. So understanding if you need to take risks at all is very important. It's not every time you need to take risks. Pete Matthews said when his clients come talking to him about investment, the first thing he asked them, they will say, "Oh, Pete, I've got this money to invest, and I want to invest it." He first of all asked them why. You've got to have a reason to invest. If you don't have a reason to invest, you're blindly going into something that you have no idea how it's going to impact your life. So why do you have to make that investment? So understand if you need to take that risk. If you don't need to take that risk, there are some people who have enough money in the short term, long term, and long run, and they have put things in place already to take care of them short term, medium, and long term. So when they've got some cash, they just say, "I want to invest this." Why do you want to invest it? That cash could better serve you. It might better serve you to leave it in the bank and live on it. Because if you want to take more risks, taking more risk with that cash might actually hurt you more than it will benefit you. But if it is a risk that you need to take because you want to build on something and you have an expectation of what this fund or that investment is to achieve for you in the next couple of years, then that's fine. Some people come to invest, and the reason they want to invest is because they want to send their children to private schools. So they are saying, "I want to put this money into an investment that will generate me X amount of money in the next 10, 12 years. And then I'm going to use that money to send my child to a private school or to a university abroad." And I get this a lot with a lot of my Nigerian clients, because we ask them questions. Why do you want to do this? So if they say, "This is why I want to invest," that is what is going to advise us and inform the quality and the kind of advice and the direction we're going to be taking that investment. So first of all, to mitigate against investment risk, understand if you have to take a risk at all. Secondly, Diversify. Do not put all your eggs in one basket. Yeah, across all types of investment, diversification is very important. If you're investing in stocks and shares, you don't have to invest all your money in one sector. You could invest, in the agricultural sector, in the technology sector, in the property sector. You can invest some, say, in special investments like maybe tobacco industries and all. Spread your investments across. If you're investing in properties, put some money into properties that generate growth, some that generate income. It could even be different locations, diversification comes in different forms. So if you want to mitigate against investment risk, go for diversification. Number 3, do not jump on the bandwagon. You see, some people just they whenever an investment opportunity comes up and everybody is doing it, they want to do it because everybody is doing it. Because everybody is doing it doesn't mean it is the right time to do it. Because what happens is when the rush is on, the price and the cost of that investment is high. So you are going into that market, into that investment at the high stage and the highest price possible. And then you buy high. By the time you want to sell, can it go any higher than it has gone already? You might end up, selling low because the bandwagon and the frenzy has come and gone, and everybody else have taken, what they've jumped into it, the cost has shot up, and then when you now want to sell, the market would have crashed. And you are now selling low. If you keep on doing that every now and then, you find yourself very, very poor in the end. Number 4, seek professional advice when you are investing, especially in areas that you do not understand. Do not think you know it all and you can do it. If it's an area you're a professional in, go in with confidence and do it. But if it's an area you're not a professional in, seek professional advice, and those professionals are well worth their money. If you're asked to pay for the advice, pay for the advice, because that's money you've paid is going to save you a lot of money, a lot of time, a lot of stress, and going to save you a lot of losses in the end. Number 5, and finally, is to consider your risk tolerance and your capacity for loss levels before you invest. Before you invest, consider what your risk tolerance is and your capacity for loss. Now, risk tolerance is basically how much money are you willing to lose in any investment. Before you go into that investment, how much are you willing to lose? How much money will you lose before you start punching your financial advisor in the face? That was what Pete Matthews said in his podcast when I listened to him. He said he will ask his clients, how much money are you prepared to lose before you start punching me in the face? It makes you think, basically, how much money am I willing to lose? How money? That's your risk tolerance. Your capacity for loss is basically how much money can you afford to lose. So the first one is how much are you prepared to lose. Then your capacity for loss is how much money can you afford to lose. How put it in a different way, how will this loss affect your standard of living, your standard of life? How will it affect your quality of life? So how much can you afford to lose? So if your net worth, if everything you've got is say £100,000, can you afford to lose £80,000 of the 80% of that? Can you afford to lose that? No. So how much money can you afford to lose? If you're able to answer these two questions, your capacity for loss and your risk tolerance, then you can make good investment decisions that will not hurt your quality of life and will not hurt you emotionally when you lose. So if you're prepared to lose everything, you say, yes, I know there's a potential for me to lose everything and I'm going in for it. If I lose, I lose. Yeah? But no, with £100,000, that's all I've got. I'm only prepared to lose maximum 20% of it. Then go for that. Put in 20% of your net worth into that investment, because that's what you can take emotionally. And then how much can you afford to lose? If I cannot afford to lose more than this, because it's going to completely destroy me if I lose more than this. So put in so consider your risk tolerance and your capacity for loss levels before you go into investments. Okay, so we're going to wrap it up here today, and I hope this has been a useful episode for you. And like I said, this is episode 10 of our Modesty's Monday Motivation Series. And I'll be back with you next Monday again, where we're going to talk about investment risk in more details. Do have a wonderful day, and please leave us a comments and let us know what you think. And if there is anything you would like us to cover, in future series, just let us know, and we'll take note of that. And whenever we can squeeze it into our schedule, we can schedule that and squeeze it in. And please do take care of yourselves and have a lovely day. Thank you for listening. Thank you for watching, and thank you for being part of this. God bless. Bye.